the February edition of Investment Advisory Review to bring you up to speed with what we see going on in the economy and the markets, taking a look at your financial journey and looking how to create, grow, protect, and preserve wealth, your family's wealth in today's economy. I am looking forward to today's discussion, but I will be honest and say I'm a little nervous because I'm doing something a little different today, something that I haven't done in a while with you. I'm going to catch up on a few things that sort of feel challenging in the environment. So we're going to jump into this, and I'll see what I can do to share and see if I can shed some light on some of the thoughts you're aware of and some of the things that maybe you're thinking but just haven't put it together yet. So hopefully tonight you'll find some value in what we're going to talk about. As always, I would remind you that there is no one-size-fits-all answer to anything. You want to make sure that whatever items you look at when it comes to investing or planning, tax strategies, legal strategies, whatever those are, you want to make sure that they match what your short, mid, and long-term goals are. And so these disclosures are here just to remind you that there is no one size that fits every situation. Every family and every individual is unique, and therefore the strategies they use for their family wealth management should also be unique for their needs. We will take a time for questions at the end, so if you have questions, please feel free to raise your hand or chat those questions in. I probably will answer them at the end. However, if I start to see a lot of questions on a particular item I'm going to cover tonight, then I will stop and take time there if that seems appropriate. So tonight we're going to take a moment to look at the market and economic review and update you from last month. I'm going to discuss with you a concept, what is real wealth. Also want to show you some new items on our website that I think would be very helpful, beneficial to you and to your family when it comes to growing and managing wealth. Then we'll close out with some wealth advisory reflections that I think are important for this discussion, review your questions, and update you on what's coming next as far as our next advisory review. So when I look at the economic engine, it's funny. During COVID, I pulled this out a few years back when we had a different administration, primarily with the Obama administration. I pulled this out because people seem to have a lot of questions and thoughts and concerns about how policies are working and what that would look like. And so I've still continued to use this because I think it does illustrate some thoughts. But I think that when we look at the chart tonight or the slide tonight, there hopefully will be some more confidence, but we'll see. When I look at GDP growth for the fourth quarter of last year, it was good. It was good. We're looking almost 3% in GDP growth, and that's a very good sign. Business profitability across the board has been better. There have been some places where there are problems, primarily tech. They had quite a few layoffs, which has had a domino effect in some other of the industries around tech. But overall, there have been a continued increase in business profitability as the supply chain whack-a-mole has continued to improve through the ingenuity of American entrepreneurs as well as entrepreneurs around the world. We see that more companies are doing better than before, but we also see some areas out there. So I gave it a plus minus. Unemployment rates, I would say unemployment rates are clearly a plus. They are at record lows right now. I'm not sure that doesn't somehow feed into another problem, which is underemployment. Employers struggling to get workers to come in and stay with them. But if I'm looking at just unemployment rates, they're clearly a plus because they're so low right now. And interest rates are a plus minus at this point, meaning that we have rising interest rates. They haven't gotten to the point where they're terribly problematic yet. And from an investor's viewpoint, somebody's looking for income, it's kind of nice to have some of those higher rates in your savings accounts or your CDs, or maybe even in some of the bonds or other programs you might use. But if you're a business owner or you're trying to buy a house, those higher interest rates have been a little more problematic. So we got a plus minus on interest rates right now. So two of these engines in the U.S. economy are pluses. They're firing. They're seemingly doing a good job. And then two of them they're running, and they're not flaming out. They're strong, but they're just not as strong as we'd like for them to be. So overall, I would say that's not a bad economic review. Simplistic as it is, it does at least give some insight into where we think things are at the current time anyway. So we're going to take a look at the markets here and take a look at some of what the thermometer of the markets, or maybe a thermostat in some cases, of what the market is. But I thought I'm going to spend some time, and this is kind of why I'm doing it a little differently tonight. I talk with many of you, and I talk with advisors across the country, and certainly our investment firm partners who bring different solutions to us. And it seems like at some level there's sort of this unspoken concern that there is a disconnect between Wall Street, Main Street, and your street. And I think that's part of what the challenge we're facing is. So I thought I was going to spend a little bit of time tonight trying to break down some of what that is and what might be causing it, and then what we might do to offset that. So let me stop for a second here and go to our software. So this is the Dow Jones Industrial Average. As you can tell, I've gone back a year in time. And as for those of you who've seen me do this before, let me turn on the element so you can see the comparatives. As those of you who've seen me do this before, you realize that the jagged line is the daily activity, what's going on in the day. The red line is a 200-day moving average, which means it's an average looking at the last 199 days with today added to that to create more of a smooth viewpoint, so you can kind of see what direction things are headed in. And then the blue line is a 50-day moving average, where it's a little faster line. It's not quite as jagged as the daily activity, but it still gives us a little quicker reaction to what might be happening at any point in time, as compared to, say, the 200-day moving average. And I think it goes without saying that the green represents up days and the red represents down days. So when I'm looking here at the Dow, since October of last year, the Dow really started doing pretty well. I mean, it looked like things were going to go south, but they didn't turn out to be that way. And if I go back here and put the line across, what you see is that we're now back where we were in August of last year. We're not quite as good as what we would have been in January of 2022, but we've hit that place where we're doing better. But it seems like it could be stalling a bit right now. And I think that has a lot to do with some of the other concerns I'm going to talk about in a moment regarding Wall Street, Main Street, and your street. Because the economy, and certainly the market's reaction to the economy, is pretty healthy. We're probably only between 5 and 10% away from the top of what we were in January. But somehow that doesn't feel right, because other things feel like they're sort of off somehow. If I'm looking here at the activity, you can see most recently that today it's gone down again, and we're down here sort of testing these previous lows. If I put it right in here, we are sort of bouncing across this bottom here. This floor of support, we appear to be approaching it, and that's a sign that could be a challenge, but I don't know that it's going to be honest with you. I don't think we're going to have a big problem. I think the markets probably are going to continue to do well, even if some of the other issues that maybe Main Street or you and I on our street find challenging. But I think the markets and the investment firms and large multinational companies, they are looking at opportunity. They see a lot to work with, and so they're growing as a result of that. So I'm going to tie this together here in a second. So this is the 30 largest companies in America broken out by several industries. If we want to see something a little different, we can look at the S&P 500 and see how it has done during the same time frame. We can see that. So again, going back to, say, August, it hasn't hit that high yet. We do see that the red line is a continued downturn, but we would also note that the highs in the last, since December, have continued to get higher until this most recent time, and the lows are still moving up, but it will be dependent upon what things look like here in the next few days. I would say that I would not be surprised if it breaks down through the 50-day and then through the 200. But I think that honestly may be the signal for a chance to get back in now and really start investing more like you have in the past. But we're going to talk about that as well. Let's take a look at one more. The Russell 2000. If we look at the Russell 2000, we can see that again, we go back to August. It did hit that high, but it didn't hold it, and it's continued to go back down. It's now bouncing off what was a previous high. It's now breaking through that, and we'll see how that looks over the next few days. Again, I personally wouldn't be surprised if it runs down here, breaks through the 50-day moving average, and then depending on what kind of news happens, what we see around the world and in the U.S., it could turn around and take off again. Now, having said that, certainly things like a war, World War III, I'm not suggesting that's what's going to happen or what that would even be. It could just be a Cold War. But if that were to happen, that certainly could be a problem. If China were to do something with Taiwan, that could be a problem. But outside of those factors, there really seems to be some movement forward, a lot of capital on hand, still low interest rates, still inflation is problematic, but is steadily moving down. Gas prices are higher than they were before the current administration stepped in, but they've come down from their highs. And so these are all pieces that the economy is looking at, and Wall Street in general is looking at and saying, I think this is something we can work with. So this kind of speaks to what's happening in the markets. I know that I had expressed concerns back here in October that we were going to see some real problems. Obviously, that has continued to show itself as being having a desire to work itself out. I try not to get in when I think things are problematic like this, but I do think that we're kind of coming to that place now where we see enough highs and the lows are getting higher that it makes me think that we're ready for another run here. Maybe we're looking at high single-digit returns this year, maybe low double-digit. Again, it's all over the board because nobody really knows. There's obviously concerns of a recession continuing. Last year, despite having 2 quarters that were negative, we still end up not in a recessionary year, and so this year may be that year we have a recession, but it could be a very short term and a very shallow recession as well. So those would be things we'll be watching here, but all the pieces on Wall Street do make me think that we're moving back into that opportunity to make some money again as we look at the markets from this economy. Now, that may seem odd. I know that, again, talking to many of you, you have concerns we're dealing with something else. And that's kind of what I wanted to spend some energy on tonight talking about. So with that in mind, let's go to that part that I was wanting to share with you. Why the disconnect is concerning. And I don't know that the concern is paramount for today, but I think there's this sort of uncomfortable feeling that somewhere down the road, this disconnect could become more problematic. And I think that's part of the concern that many people have. So now I'm going to use this chart and start off the right side of the chart. We're going to go backwards. I'm going to start on your street, our street. Each of us has thoughts about what's going on in the economy and such. And there's obviously the concern of the rising cost of living and how much harder it is to make things work now than it was, say, even a couple of years ago. Job layoffs, although not many people I've spoken to have had problems with job layoffs, but I think a lot of people are concerned that somehow that could be a problem down the road for others. Rising interest rates, if the Fed is able to control rising interest rates and not make it problematic, keep it from becoming a problem, I think that'll be fine. But I do think that is something that many are concerned about. Even as I've talked with some of you who are trying to get houses and do mortgages, you're finding it's harder to do that. We find some banks are not lending much money now, and they're actually doing things to inhibit loaning money for houses. So there's some issues there going on in the economy that I think are interesting. Increasing taxes. We are seeing discussions about taxes increasing. I think it's going to be harder to get that done in the last 2 years of the Biden's presidency. But I do think that it is a concern, and there certainly is other taxes that are being levied upon people rather than just federal income taxes. And then government intervention, which I think is probably the one thing that I find most interesting about this conversation, is that depending upon where you stand politically, Government intervention is one of those things where either A, people think it's not enough, there should be more government intervention to fix things. And then other people, depending on where they sit on the political spectrum, they think that we need to have less government intervention. So you either think there's too much or too little, depending on your political views. And I think that's part of this big discussion going on in the country and across the board as it relates to the economy. Now, when we go to Main Street has a little different viewpoint, but not too dissimilar. Main Street is concerned about rising cost of business. Certainly, many businesses have either sold or gone out of business. New businesses have replaced them. And the rising cost of business has certainly been one of the big issues connected to that. Every month I hear of a business that's been here for a long time that has shut their doors. And it's because of the rising cost of business. That's what they've expressed in almost every single case. Increasing wages. I just got a call today from a friend of mine who's like, so I got to hire some employees. What is the going rate for this job? And so we did some research and answered. And increasing wages. He made a comment that he can't imagine this is what he paid his best employees before. And now just to get people in the door, he's having to raise his wages to meet this new wage thinking that people have today. Underemployment. It's amazing how when you go into restaurants, they're like, we can't let you have a reservation because we're going to be full. But you go in there, it's not full, and it's because they don't have enough employees. And it's not just there, it's a lot of places where I find that it's hard for people to find, or for business owners to find good quality candidates to do the jobs they want, either because they don't want to work or because, meaning the people don't want to do that job, or because the wages are being paid by bigger companies who have a bigger bank to pull from to pay those wages. Rising interest rates, small businesses are really struggling with that. It's been a problem for them when it comes to how they're handling floor plans and rents and buying businesses or buying property. Those are all issues that they're working with. Increasing taxes and fees across the board, whereas rising cost of living for all of us is problematic. The fees and the expenses that get stuck on small business now are just more than they've ever seen before. And then finally, government intervention. I think most businesses tend to think there's too much government intervention. Most Main Street businesses would like to see much less, and that would help them have more money to pay employees and to meet the needs of their customers and to grow their business. So your street, Main Street, and now let's look at Wall Street. And this, I think, is where we see the disconnect, because Wall Street sees this differently. They see this differently than you and I do. They see this differently than Main Street sees it, because what they're really looking at is capital investment. They're interested in how Main Street's doing, but only to the point of how it impacts capital investment. They don't particularly care because they're not involved in the day-to-day operations of a business. They're just wanting to get the growth off of that, or the income off of that. Return on assets and return on equity, which we'll talk more about in a minute, but when they're looking at how they value a business and how they value a stock, if they're going to invest in a stock, or how they value what they might do if they're going to lend money or do a bond issue. Return on assets and equity are two issues that they're looking at, because again, it's not day-to-day manufacturing or whatever, or distribution. It is the return on assets and equity that drive their thinking. Quarterly earnings reports, they watch those like a hawk. And quite honestly, quarterly earnings reports used to be simply an update of what's going on. Now they're a big production, making sure that your quarterly earnings report reads well so that your stock price won't drop, which is then a big impact on Wall Street and investment bankers and brokers and advisors, because they're watching a reaction to something that may or may not be totally accurate. I'm not saying that the quarterly earnings reports are wrong, but there is definitely the ability to manipulate dollars and move them from one place to another during a quarter or toward the end of a quarter to make the report look better than it is. And we've certainly seen that happen before in other companies. Fed watching, what the Fed has to say, because it's a governmental institution, and the watching for that seems to be a huge issue that the Wall Street and the investment firms are keeping their eye on. ESG, environmental, social, and governance policies, big issues now in a lot of companies. I just had a client reach out to me the other day and said, hey, do you think this is going to be a problem based on some new rules that came out of the Biden administration? And what I said was that currently 90% of the Fortune 500 are already working under ESG thinking. We don't, if you understand what the ESG debate is or such, then I really don't have to go too far into that discussion. But if you don't, if you're new to the party, it is certainly making sure that all this social scoring and how we're handling environmental issues and using governance to control certain matters. These are all items that that Wall Street is watching carefully because they're very important to them. Maybe not so much to Main Street or your street, but to Wall Street, it's a big deal. And then finally, government intervention. I think it's reasonable to say that especially for multinational companies, for S&P 500 companies, for the Dow companies, even for the Russell 2000, many of them would like to have more government intervention. And you might say, why would they want that? And this may be that place where you start to see a difference in the two groups, is that the government intervention, if you're Bank of America or you're Amazon, government intervention means that you have the capacity to work through that government regulation and stay in business and keep going. But a small business can't compete. And so using government regulations to help control the business environment is something that a lot of large companies really like. That's why they put so much money into lobbying. It doesn't matter that it's going to hurt Main Street. It just matters that it's going to work for them. Now, if you think that what I'm saying is, oh, they're evil, they're bad, and so on, I'm not saying that. What I'm saying is that we need to be aware that's what's going on, because it helps us make better decisions along the way. If we want to vote differently, to get politicians in who think differently about how we're going to handle items like that in our country, that's obviously one level. But from an investment viewpoint, as an advisor, I'm required to think through this process and try to figure out, how do we manage this? How do we maneuver our clients' accounts and assets and wealth through this process to get the best outcome? Because I can't make Wall Street change their mind, but what I can do is take a look at what items help make the best opportunities for our clients. And honestly, this topic, I could spend probably all night talking about this, because I think not just Wall Street, but Main Street, your street, how these pieces fit together. But I decided what I was going to do is just take some time tonight to hit on basically three concepts. And this is the start of the first one, which is the economic outlook problematic? I think it's obvious that it's a challenge, and we're struggling with some of the challenges of the economic outlook. Main Street, some businesses are doing phenomenally well right now. Commercial construction is doing well. Multifamily is doing well in some sectors, but doing terrible in other sectors. Small business, where it's distribution or small-time stores or stores that specialize in boutique kind of products and services. Those companies are having a more difficult time right now. Restaurants are having a difficult time, but the big chains are doing much better because they have a different process. They have a whole process when it comes to working through regulatory items. They have legal departments. They have all kinds of resources to keep everything going. So I could sit and rail about how that is fair or unfair, but the reality is that my job is to try to figure out the best way. Your job is to try to figure out the best way to maneuver this so that we can grow wealth to meet your long-term needs, your short, mid, and long-term needs. So is the economic outlook problematic? I think it is. Is it impossible to maneuver? I don't think so, but I do think that we have to be wise and sort of thoughtful in our process how we're going to go forward with this. So now, if we take that sort of to the next level, I wanted to get a thought out here, which is, what is real wealth? And it's a more complex question than you might think. I listen to lots of different resources to try to stay connected with what makes sense, and then to identify what might not make sense. And lately, in the last year or so, I've been hearing different things that I thought were sort of fascinating about how real wealth should actually be looked at, whether, again, it's Wall Street, Main Street, or your street. So if I'm going to do that, it's a complex question, maybe more than what you might think, and so I'm going to try to wade down a little bit into it to identify what that is. Now, you've seen this chart before. I identified the 8 different asset groups that we invest in and try to help our clients be diversified and meet their growth needs and have flexibility and have income opportunities when they need those. And This is what we do from an investment viewpoint. But if you were to stop and think for a moment about real wealth, and this isn't exhaustive either, but if you start to think about what is real wealth, start to think about what types of wealth do you have, you would say, well, I've got cash and checking, maybe savings, CDs. You have vehicles. If you might have some equipment. You might not think of yourself as having equipment, but you do if you have a TV and a refrigerator. If you're a business owner, you have even more equipment and machinery. You have your home. That's a piece of wealth. You have insurance policies, which is a protection process to protect against catastrophic loss of income or assets. And some of those insurance products might even have cash value in them, like life insurance. Bonds, which is an asset that loans money out to people and pays back interest to the loaners for the use of their money. Stocks, which represent ownership assets, where you own a piece of a company. Annuities, where you have an insurance company who gets in between and they provide certain guarantees or stabilizers to offset risk that you might want to avoid. Property outside of your home. It could be personal property. It could be real estate that you own outside of your home. It could be business property. Precious metals and industrial metals, which I'm going to show you why I know a fair number of you own precious metals, and as a commodity, it's something that you find a lot of solace in. I agree with that, but it is certainly a type of wealth. Your business, if you're a business owner, and whether you have a small business or you have a big small business, that is certainly another type of wealth. Commodities, energy, grains, pork bellies, things of that nature. Crypto, which really hasn't been defined very well by any governmental agency, but it is clear that it is some sort of a piece of wealth, because it has made a lot of people very wealthy, and it's made even more people poor because they didn't understand how it worked. Again, I'm not putting any judgment or rationale on any of these types of assets. They all have strengths and weaknesses, but they do represent a way to kind of consider what types of wealth do you have. And again, this isn't exhaustive. We could break this down and down and down, and there was so much I could have put in this chart, but I just wanted to kind of expand how people think about wealth from an advisory viewpoint. So along with that, and this is going to kind of be where I drive down a little bit into some of the thinking about money, past, present, and future. If you go back into history, I just listened to a fascinating podcast from a gentleman who his whole focus is on buying and selling mines, M-I-N-E-S, mines, and holding those, value them, and then selling them for a profit in the future, whether that's a short-term future or long-term future. But in that podcast, he talked a great deal about how the thing about metal is it is really the sort of first real type of currency, coins, that we had. It's true that there were some societies that used wood or other things for a currency, but coinage, those little hard pieces of metal, you're able to manufacture those and process them in a way, and they were more durable and they would last longer. And so that type of coinage was really the first real money that we actually had of any value on a broad basis. So coinage was obviously made with metals, industrial metals. There are some coins that were in bronze or copper, others that were made in silver and gold. And the reason I have it that way is that what's very interesting is when you look at the amount of gold that exists on planet Earth, it's minuscule. It's very hard to produce more of it. I was just watching a show last week about these different companies that were competing to mine gold and basically pulling out literally tons and tons and tons of dirt to get granular sand type gold in grams, in micrograms, the small amounts of minuscule amounts of gold. It's so hard to get it. Silver, there's more copper, and there's more bronze out there. And so even the very value of some of these types of coins start to give us a clue to what wealth is. The ability to have something that has substance and can be used for more than just coins. Talk about that in a second. Coins, while they're great, they're heavy, and you got to carry them in your pockets, and it's no fun, and You'd have to carry giant coins if you're going to try to match them up to valuations, and it's just a mess. So we went to paper. As societies went along, we moved to paper, and we went to originally asset-backed paper. And that asset-backed paper could be backed by land or metals, something that had something more solvent. Like there was a time when U.S. currency, most currency, was backed by gold, and then today, no society has a metals-backed, a gold-backed currency. Now currency is backed by the taxing authority of the government. No matter what nation it is, it's backed by its ability to tax. So it's a faith-backed currency. We're trusting that a government would have the ability to make that paper that's in our pocket worth what we think it's worth. So that's where we are today, and most societies have that. You may have noticed that, matter of fact, coins are kind of going away. After COVID, you started seeing signs everywhere saying, you know, we don't have any coins. If you have some, we'll trade you out coins for dollars. Coins are different, and paper is what people use. However, that's not where we are today as well. We are kind of shifting, and we're going to more of a digital kind of currency, an NGO, non-governmental organization crypto. Meaning that some organization, whether it's Bitcoin or Ethereum or any of the other thousands that are out there, or FTX, if you know what that is, it's some group that said, hey, we're going to create an artificial currency and we're going to use it as a promise backed by blue sky. It's a promise that we're going to only create this much in this blockchain and say that's all there is. And so that will determine the value of it. But that promise could go away in a heartbeat. They could change their mind and double the amount, and then that makes that currency go down because there's nothing backing it other than a promise. And to be honest, I think it's realistic to say if we look into the future, I hear more and more about it today, central banked digital currency. Someday we might have a government-backed crypto. It could be a national crypto, it could be an international crypto. Backed by what? I don't know. Would it be backed by the taxing authority of that government? Or if it's like an international monetary fund, would it be backed by the world? Would it be backed by assets, hard assets? Don't know. But when you start to look at money, this currency, this wealth that we hang on to, because money is both. It is currency. You can use it for commerce, but it's also wealth. When you start to look at it in this sense, you begin to realize that money, currency, coinage, they represent something very interesting about what is real and what is not real. And I think that's where I wanted to start this, to think about what is real wealth. What is real wealth? Or there are many categories of wealth. If you look at balance sheets for companies, there's current assets versus fixed assets. And then for individuals and in companies, there's variable assets as well. There's personal property, there's business property, there's brand/intellectual property. There's traditional assets versus contemporary assets. There's tangible assets versus intangible assets. And I'm going to even add to it youthful capital versus experiential capital, because all of these types of wealth represent opportunities for growth, but also represent various amounts of risk that people have to consider when they choose to invest this way. So if I were to break out these different types, what I would say is this. Current assets are typically thought of as assets that are short-term, available within a 12-month period of time. Fixed assets are typically assets that are seen as longer than that 12-month period of time. They probably can't be converted to liquidity or reserves or cash any faster than 12 months. So current assets are within 12 months, fixed assets are longer. And I am simplifying here because this, again, can't be exhaustive, but it starts to lay out a thought process for you. Variable assets, which are volatile, meaning they're subject to economic and market fluctuations. Then you drop to the bottom line, personal property, assets that are owned by individuals and families. Business property, assets that are owned by businesses and corporations. And brand or intellectual property are assets owned by businesses, corporations, and are typically thought of as blue sky. Now, the others, you probably get those pretty well. Let me just stop for a second on brand or intellectual property. Suppose you've got a brand, I'm not going to name any company because I don't want to sound like I'm saying something bad about somebody or good about somebody, but You can think of brands that you've heard about before that maybe they were great brands at one time, but then something bad happened. Maybe they had a bad product or they had a bad situation or whatever, and that brand wasn't worth anything anymore. Or that brand was seriously damaged in the discussion. And that's just simply blue sky. It was good one day, and then some bad things happened. It wasn't good anymore. Same thing's true with intellectual property. Maybe you have an idea that has a lot of power and could produce huge amounts of wealth, but then something comes along that makes your idea useless. So it had no real value. It's just blue sky. But make no mistake, that brand or intellectual property is certainly what has made many corporations, Dow, S&P 500, Russell 2000, multinational corporations, that brand and intellectual thinking is what has made those companies worth billions and billions of dollars. So it is clearly an asset model, even though it's not something that most of us think of. We're back to either current assets or fixed assets, personal property, maybe variable assets or business property, but make no mistake, it is that difference between these huge multinational companies, and that's why they protect their brands so carefully. That's why they protect their intellectual property so carefully, but it's also what makes their stock, their the equity ownership in their companies so valuable as well. So if we look at tangible assets, what I mean by tangible are these are things that you can actually get a hold of. You can sort of put your arms around them. They're tangible. If modern society were to collapse, I don't think that's what's going to happen, but if it did, these would still remain. They would likely still be in position because you would still need them. They're connected to something real. That's why they're traditional and tangible. And they're the building blocks of all investment or wealth. So what are they? Well, land for farming. And when we had a land economy, long before we had the Industrial Revolution, generation after generation would pass land on. And that was the wealth. And maybe one landowner, he and his wife would have a son, and he would know somebody on the next farm over, and that man and his wife would have a daughter, and they'd marry and they'd combine the farms, and they would grow wealth that way. That was how the land economy worked. And then when the Industrial Revolution happened, we changed from a land economy to an income economy. We went from land to income, meaning that the family farm, which was that thing that was passed from generation to generation, people didn't own the family farm. Many people didn't. They gave up the family farm. They got jobs. They worked for companies, and they had to rebuild their assets in other things. Along with that farming economy, you had commodities. These are the things that we need to live. They usually have a short time frame, meaning these things are like wheat, grains, pork bellies, beef, things that they have a short time frame that you can use them. And so as an asset, they have the time that they're useful. You can sell them and make a profit, but if you hold on to them too long, they won't be worth anything. And certainly within commodities, you have industrial metals and so on. Those can exchange on that. But in the sense of commodities this way, land is obviously a long-term thing, and the commodities I'm referring to in this case are more the short-term things. If you go down to the bottom left, you'll see metals there, and this is where you start to begin to think through the difference in real wealth, if you will, versus other things. And that is, if you have bronze could be a coin, but it could also be a tool. It could be a weapon. It could be jewelry. You could take copper, you could take silver, you could take gold, and you could use them for many different things. And even though you might use it as a coin to start with, if times became tough and you need it for something else, you could melt it into something and then fashion it into something that you could sell that had different value. Then we go to trade, which would be sort of like a commerce model, typically non-farming. It might be that somebody's inventing something or somebody's producing something. It may be that somebody's building something. And maybe they're distributing something. It's commerce. And having that thing that you do, that skill set to invent or to build or to produce or to distribute, those are skills that have value. And that even if the economy and the world collapsed, those would still be things that would be needed, and they represent a more traditional or tangible way to see wealth. Now, we compare that to more contemporary assets. These are more intangible. These are things that really you can't actually hold in many cases. They might be pieces of paper. They might be things that identify a title or a registration. They might be a a certificate that expresses something. So they're intangible. If modern society collapsed, some of them wouldn't be here. There might not be need for some of these things if the society collapsed. Some of them are still connected to something real, but that connection's diluted by layers of expenses, fees, and management and people. Some aren't connected to anything real. And these are bubbles that are in the modern investment world or wealth itself. The thing about them is, again, I'm not painting them as bad. They're not. They could be ways that people make huge amounts of money, but they can also be ways that people lose money too because of the risk associated with it that isn't so easily understood. If we look at some of the items here, going back to metals for a second, down here, this bottom circle, possessions, trinkets, stuff, wares. You know, it's one thing to have a solid gold bracelet. It's another thing to have a trinket that looks like gold but really isn't. And yet, you see people today who have more of the latter and less of the former. There's nothing wrong with trinkets or stuff or possessions. It's just that they're not real. They just look like facsimiles of what's real. They're not. That's why they're not considered to be wealth. You've got banking, currency, which we talked about currency a moment ago, Federal Reserve, and the International Monetary Fund. These are processes, layers that create expenses and fees and controls and complexities that make it hard to tell where things are going. The banking system, pre-2020, if you took $100 into the bank, they had to keep $10 of it, and I'm oversimplifying, they had to keep $10 of it in the bank, and then they could loan out $90, which meant that's pretty cool. They could pay you a little bit of interest on your $100 and take 90 of them and go out and charge a lot more interest. But they had to keep a minimum of 10 in your account. Well, that changed after 2020. It's now down to almost nothing. They can lend out the whole $100 now. So what happens if things fall apart? I mean, I'm not saying they're going to, but it is part of that thing that at some level we all are aware somehow that something's different, and it's concerning. I already explained about currency. The dollar that you and I have in our wallets, chances are it's not worth $1 at all. I mean, I say chances are, it's not worth $1 anymore. It's a trust factor between us. That's why when you print more and more of those pieces of paper, you're going to have more dollars chasing fewer goods, and it's going to create inflation. You take a look at stocks. Stocks represent ownerships in companies. It's great. There's nothing wrong with that. People have made a lot of money doing that. But at the same time, you just have a small piece without any say. It's a lot different than if you went in business with somebody who knew what they were doing, or maybe somebody joined you and they brought capital, you brought your know-how. A lot more control in that. But the stocks do represent ownership, but it's just a piece of paper that's connected to something real, but we don't really understand what that realness is sometimes. Exchanges where you trade these stocks, mutual funds, which are pools of these stocks, interval funds, which are a different way to create more stability by giving up some liquidity, initial public offerings or companies that want to go public and you're taking a bigger risk, but you have more chance for gain. Annuities, which can grow tax deferred. They're offered by insurance companies. They represent models of other things, but they have guarantees or riders or stabilizers in them to protect against losses. Cash value life insurance, also another asset that can provide, but you don't really, most time people say, well, I don't really know what it's invested in. Again, that layer, that complexity, those are issues. Not that they're bad, they just are. Financing, lending, leasing, those are another way that people make money, whether you're loaning at somebody or you're investing in some organization and they loan it out, give you back your money with interest. Real estate investment trusts up here at this bubble. I don't mean bubble in the sense like it bursts, just that circle, that bucket we'll call it. Real estate investment trusts, collateralized mortgage obligations, collateral, goodness gracious, distribution organizations. That's not right. And then I'll think what it is. But and then real estate limited partnerships represent real estate, different ways to own real estate, and you can diversify those into single family, multifamily, storage, entertainment, commercial, Class C, Class B, Class A. All kinds of different investment opportunities there. But again, you're putting your money into a pool, not of stocks in this case, but of actual real estate. But there's layers there. with additional fees and expenses. One thing to do it that way, another thing to do, you go out and buy a piece of property yourself and you do all the work. And then finally, the thing that kind of sort of drove this whole conversation was crypto. One of the reasons I kind of hit this or decided to hit this way is that crypto, as I said a moment ago, is currently as an NGO, a non-governmental organization, making a promise that they won't increase the number of them. But just like the federal government prints out more dollars, who's to say that that organization couldn't say, well, we're gonna double it now, which cuts the value of it in half. Bitcoin, which many people have done very well with Bitcoin, and I get it. It's an interesting investment, although the government won't define it as an investment. They won't define it as a currency. They won't define it as any sort of asset or a commodity, because they won't put any governmental organization over it. FTX, if you have been following anything lately, FTX, Sam Bankman-Fried, whether it's because he didn't understand what he was doing or because he's just a big scammer, lost literally billions of dollars because he created a crypto model that fell apart, but fell apart in a very catastrophic and incredibly large way. And then CBDCs, central banking digital currency, which depending on what you follow about things of this nature, it's a desire that someday there might be a governmental crypto. But then what that means is that every transaction you and I do would run through a digital model that it could all be seen. You have dollars in your wallet, you spend them now, nobody knows what you do with them. But you run it through a crypto model where the government can see everything, that scares some people. And again, then what do we really have? Do we have something backed by anything, or is it just backed by a promise? So when we look at contemporary assets, I'm not making any judgment whether these are good or bad. Again, all of them have made money, and many of them have lost money. It's not that they're good or bad, it's just understanding the complexities of them in light of how traditional assets work and how their connection to them is so critical that I wanted to say this is a part of what I think is happening in this lack of, or this problematic connection between Wall Street, Main Street, and your street, because all of these assets have more complexities and controls attached to them. There's influences that drive them that may not be obvious to us. Interest that is connected to them. Inflation can eat away at them quickly because they don't have anything real attached to some of them. Expenses, taxes, volatile nature of some of them. These are the things that when we're looking at how we invest in today's world, we have to really start thinking about what is real wealth and how do I do this in a way that gives my family the best opportunity to create, grow, protect, and preserve wealth. We're doing on time here. Oh, okay, goodness. So what is real wealth? Well, what this is right here is these are calculations. I mentioned that when Wall Street looks at things, what they do is they look at return on assets, which is a particular calculation that they use, or return on equity. When you look at value investing, which is what Warren Buffett or others of his nature would focus on, these are things that you're looking at to try to figure out if a company is intrinsically worth more than what is currently trading for on the stock exchange. And the belief is if you buy it at that lower level, sooner or later it will catch up. But that's not true either. I mean, sometimes it does catch up. Maybe many times it catches up, but sometimes it doesn't. So return on assets, return on equity, return on investment, you can see there's two different models for calculation there. Those are the kind of ideas and concepts that drive Wall Street. And again, there's nothing wrong with it. I'm going to keep saying that because I don't want to say that this is good and that's bad, because everything that I've shown you has made somebody money, including FTX. The original people in FTX, they made money. If they got out, they kept that money. If they didn't, they lost it. So items making money or losing money is just part of the process. But for the investor or their advisors to understand it, to me, is what's critical when we look at what is real wealth. Now, I mentioned to you youthful capital versus experiential capital. And what I'd like to do is suggest that there is one other piece to this. And this actually came from Jordan Peterson, if you know who he is, podcast he did. He talked about how a 22-year-old man who is healthy and likes to work and wants to go out and make his mark on the world, or it could be a girl too, a woman, same thing, 22-year-old woman could do the same thing. They have a huge amount of wealth locked inside of them that hasn't yet shown itself. And so that wealth for youthful capital is time value of work and capital. If those people, those young people, are driven to succeed, if they're visionary, innovative, progressive in their thinking, and able to see opportunities, acutely aware of previous generation shortcomings. That's part of the problem for them. They see our failures and they say, I can fix that. And sometimes they have unwarranted confidence in the future and maybe in themselves. They think they've got it all figured out. They're 25 years old. They don't know hardly anything yet, but that doesn't mean they don't have a good idea. And they have minimal experience with failure, so they don't quite understand how painful failure can be yet. At the same time, on the other side of that equation is experiential capital. That's the older people of us listening, because we have that capital for investment. Those young people, all they have is time and drive for capital. We have the actual capital to work with. We're driven to succeed just like they are, but we have some other thoughts behind that. We're visionary, we're mature, we're conservative because we've seen things work and we've seen things fail. But we've also recognized that every successful person at one time had that youthful capital. We're acutely aware of current generation shortcomings. We can see what they do wrong and it scares us. But sometimes we miss opportunity because we're not looking carefully at it. Sometimes we're overly confident in our past successes and we have fear of failure because we've been kicked in the teeth a few times. Having said all that, you put these two groups together with intelligence and with maturity, and you can create some huge wealth with that. And we've certainly seen that with a lot of different things, even in the last 2 decades. Many of the things that you and I buy today didn't exist before 2000. Starting with that phone that you have. These things didn't exist before, but because you had youthful capital had one idea and experiential capital had another idea and they came together, that's an important piece of this discussion as well, and trying to figure out how those fit also has a lot to do with what is real wealth. So that brings me to the second part with all these little circles. So if there is a problematic economy, how are we investing in this challenging environment? Well, one thing is we try to diversify. We try to identify what our clients' needs are, what your needs are. We try to invest with that in mind. And then we try to stay as closely connected to the real as we can. And we try to, if we're going to move away from the real, to get some things like a stock or an insurance program or something of that nature, or real estate investment trust. We try to make sure there are stabilizers and protections built inside of it that give us a better chance if things go sideways. Because that's the best we can do. I mean, we could watch a TV show where the host says bye, 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 and go out and buy that stock, but that person's gonna have no responsibility in that process. If it doesn't work tomorrow, well, I'm sorry, but tune in tomorrow night, I'll tell you something new. But in reality, what we wanna do is take a look at what works, what's connected to real as much as possible, what provides stabilizers and protections, and then diversify to not put all of our eggs in one basket, because some things are going to work really well and some things might not, but we want to diversify to give us the best chance to make that work. That's what a professional fiduciary process would look like, using multiple approaches rather than just stocks or bonds or cash. And so that brings me to the last question, what is real wealth? Well, sure, real wealth would be return on assets, return on equity, return on investments, but what I would suggest is real wealth is actually return on life. It can't be calculated. All we can do is estimate it. And here's what I would say. If you look down at this bottom paragraph, it's right here. We won't be thinking about ROA or ROE or ROI as we take our last few breaths of air on this planet. We'll be thinking about what we did with what we have, the experiences that we went through that were worth remembering, and the people we love or should have loved more. That's ROL, and I think that's what real wealth looks like. I think that to understand the other pieces is critical, but it's crucial to really know what it is we're trying to do with whatever wealth it is we have. On our Retirementality program we use with people, we identify a number of things that people are thinking about as they start to move through various phases in their life. Our goal as financial planners, as wealth advisors, is to help people think about, what do I want to do this year? What do I want to do in the next 5 years? What do I want to do? What's my bucket list? And so what is real wealth? Well, it's ROL. What type of return on life are you looking for? ROI is critical. You have to have good return on investment, no doubt about it. But ROL is crucial. And that's why we've been moving along this path to go to an advisory viewpoint, not just for investments, but for wealth in general. And that's kind of the strategy that I decided tonight to look at, to say, is there something problematic in the economy? I think everybody realizes there's something going on that's a little challenging. How do we offset that to the best of our ability? And then what does real wealth look like? It looks like the ability for you to do the things you feel called to do, so that as we check out on this planet someday, we're like, I did what I wanted. I did what I thought was right. I did what I thought was best. Create, grow, protect, and preserve wealth. The 3 phases of our journey is first the accumulation phase, where we build wealth, build wealth, build wealth. Then somewhere down the road, we don't have the capacity to go out and do the work anymore in the way we did before. Then we have to decumulate. That's where we retire. And so we have to make sure we got enough to get through the first 5 years of our planning, because those are crucial to make sure we have enough money to last for the rest of our life. We have to make sure our end of life risk is wisely thought out, so that if we die and our spouse is left here, they've got resources. Want to make sure that as we check out, that we have achieved our desired return on life, and that then what's left, we can transfer it to those people that we love and care about. That's what this sort of advisory thinking is about. On our website, I've gone a little bit over. I was going to spend some time on the website. It's not over yet, but it's about to be. I'll just remind you this, but I wanted to take you through the website and show you some of our things. I'm going to save that for next month, where I will spend more time touring our website. But I would encourage you to realize we've got some really awesome things in there. First of all, we've got our whole team on there now, and we've got these webinars are on there. We try to get them on within 30 days. We've got to get approval from our broker dealer and so on, so we can't just like stick it on there, but we're working through that. But we've got most of them up there until the end of this last year. We also have other resources we use. One of those companies is called Real Wealth. It's on there. I do a blog every week. Let me just, okay, I'm going to take 1 second here to do this. Let me stop it. Go back over there. I want to get you out of here quick, but I do want to show you. So this is our website. If you go to menu here, I already showed you the login pages. I'll talk about this next month. Wealth management resources. Got different calculators, we got different things you can do. This is where you can go and log into all of your accounts, educational resources. We've got the market update videos. These, we save those on there for a few months so you can watch them. Real Wealth podcast, which isn't connected to what I was saying, what is Real Wealth, but they're a great resource that we really love to use. I have a blog that you can go to, and every week we put on a new update. So you can go in there and read that. Some of you are getting these through your emails. Some of you are not. If you want to, then you can go in there and check it out. And we're just trying to really help you understand how to create, grow, protect, and preserve wealth. And this is part of how we do that. All right. So in bringing this to a close today, as I shared with you last time, we really are focused on the return on life planning process. We believe that as a fiduciary wealth advisory process, it's going to require a vigorous financial planning strategy. I'm already working through that with dozens of you right now, because we're at the first of the year. If you've not had your appointment yet to update your annual service agreement and take a look at your planning process and how we're handling wealth advisory for you, please give a call. Let Kayla schedule you time so we can sit down and talk about it. I love it. I got to tell you, it really brings investment and risk management processes together in just a fantastic way. I love the conversation I'm having with clients about this process. I hope you'll love it too. So let me stop there and say, do we have any questions? I'm just going to quickly check to see if we have any questions in chat. Nope, don't see any questions there. Don't see any questions there. So I'm going to close that for a second. But if you do, go ahead and chat them in or raise your hand or whatever, and I'll come back to it. So our next advisory review will be in March on the 21st. We're going to talk more about how we're helping clients to create, grow, protect, and preserve wealth, give you more understanding of fundamentals and technical analytics for the market and the economy, show you some more of the solutions that we're using to help keep tax money on your side of the table, how to keep fees and expenses lower, so that way it's easier to keep your wealth growing, and then obviously take time to answer questions that come out of our meetings with you and even some of the emails you send us. So we took time to review the market and the economy. I hope that was helpful. I know it was probably like drinking out of a fire hose. And like I said, I could have talked on that whole process with that and what is real wealth. I could have probably talked on that for 4 hours tonight, because I think it's such a fascinating and critical conversation. But I wanted just to give you enough to really sort of whet your appetite, maybe cause you to look for a few more things, and certainly give you questions to ask if there's anything that we can help with on that. Went through our website a little bit. I'm going to do more of that next month because I just ran out of time. I gave you some of my reflections on what I think's happening and what we're looking at doing. And then, oh, I see a question come up, so I was going to just about to say we're going to answer your questions. And let's see here. Do I see a question? I see a hand raised. That's not it. Question. Go to chat. Saw a hand go up. Oh, I know what it is. Okay. Oh, I got you. All right. Let me see if I can. Diane, it looks like you want to talk. Can you talk? You might have to unmute yourself. I might even be able to unmute you.
The question is, what is our current currency money backed by?
I'm sorry, I heard part of that question. Say that again.
Okay, so what is our current currency backed by?
It is backed by the full faith and credit of the United States government ability to tax its citizens. It would be fair to say that there are assets that the United States of America owns, and possibly those could be brought into the mix. But if we were to have a conversation about the Federal Reserve and how it works and what the currency itself is backed by, it really isn't backed like it was in years. And this is not a statement about President Nixon, but he was the one who took us off the gold standard. And prior to that, the US dollar was attached to metals. Prior to that, or after that, it stopped being that way. There's also a fascinating story, if you're ever interested. Abraham Lincoln, to fund the Civil War, went to the bankers in New York to try to borrow money to fund the war. They wanted to charge him 20–25% interest. So he came back and he was furious. And so one of his cabinet secretaries said, you know, you don't need to run it through the Federal Reserve. You can back it by the assets of the United States of America. So for the only time in our history, it was actually for those dollar bills, that currency during the Civil War, some of that currency was backed by the direct assets of the United States of America. Today, not so much.
Okay, so what would you say is the best asset backing available in this day and time?
Well, for one thing, there's no currency in the world that is backed by gold or precious metals. It's all backed by the taxing authority or the assets, if you will, in a sort of circumvented view of those nations. So here's the problem with this thing, and I'll answer this question, and I'm gonna go ahead and have to go on, because the truth is this is a big question. If you're really interested, you might want to, and I don't know if you can find it anymore, but there's a long video, like 4 hours. It's called The Federal Reserve, Not Federal, No Reserve. And it does a really good job of explaining how currency works. Having said that, though, here's what I would say, is that the dollar bill in my wallet and the dollar bill in your wallet is a means of commerce and exchange for goods and services. We trust that and we accept it. So if I hand you $1, if you want $1 for something and I hand it to you and you give me something back in exchange, we accept that. That's a commerce model. It's a commerce model. How much is your car worth? Well, it's worth whatever somebody will pay you for it. How much is $1 worth? Well, it's worth whatever somebody will take for in exchange for good or service. Being backed by the federal government is, in essence, in some ways, not real, but in other ways, it's very real, because they print the money, they control the money, they do everything they can to make sure that counterfeiters can't produce more and more and more of it, and then totally devalue it, and we don't know what's real and what's not. So they do protect it. But the problem is that It's not backed by an asset like we would like. And I would just say, quite honestly, we'll probably never go back to that. I can't foresee a time when we'll ever be able to get back to that model again. But who knows? I guess weirder things have happened. So I would say don't let this cause you to lose sleep at night. It's not that kind of a thing, but just realize that when you invest money, we should invest things that have as much connection to real or have stabilizers, riders, protections on it that we have confidence can be guaranteed. And so that's how I would leave that conversation. Again, there's just, this conversation goes so skew if I go farther with it. I would just simply say, don't lose sleep tonight, keep doing what you're doing, and just make the best decisions to try to stay connected to traditional assets or with protections that you have confidence you can trust as a way to invest for the long term. And honestly, that's what we do every day here. That's all we can do, is try to pick out the good from the bad, make the most of it, try to create the best model for our clients so they can create, grow, protect, and preserve wealth. And that's the best all of us can do. So I don't take that as a bad thing. It's just the way it is. So we'll make the best of it just like you are. All right. That was a good question, Diane, and I get it, and I wish we had a better answer for you, but that's just the way it is right now. And so that's why we work really hard to try to make sure that everything is as optimal as it can be. Not perfect, excellent. We shoot for the best all the time. All right, well, I've run over by 7 minutes, so I'm going to jump off of here. Again, it was my pleasure to share with you tonight. I look forward to sharing some more of this and some other items that we've got working on for our upcoming investment advisory for you. And so between now and then, if you have any questions, you can certainly email us. You can email Kayla at franksoffice.com, and she'll be happy to get those to me. Or if you want, just call and schedule a meeting. We'll be happy to sit down and talk with you and help answer these questions and help you figure out what you're going to do to, and remember, this is what the real wealth is, to create the best return on life you can with what you have, with your income and your outgo, what you own and what you owe, to make the most of it, to accomplish all the things that you're trying to do in your life. And that's my pleasure to help you do that. So with that, I think I'm going to go get some dinner, and I will look forward to talking to you soon, at least on March 21st, if not before. So have a great evening. I'll talk with you soon. God bless.